Look, if you think bad credit only hurts your ability to borrow money, you need to think again. Bad credit is an invisible tax that's draining your income, limiting your opportunities, and sabotaging your chances to build real wealth. Now listen, I want to give you ways to fix your credit on this video. But first, I need to dig into exactly how this bad credit is keeping you on the struggle bus. I want to give you a few facts that you should think about. Credit card debt is really on the rise. Right now, there's about 14 out of every $100 owed on credit cards is over 30 days late. Now, that's the highest that rate has been in years. And it means that basically more people are falling behind on the basics of paying back something as simple as a credit card. Now, when you talk about student loans, there's a student loan crisis too. As of spring of this year, just a few months ago, almost 1 out of 3 student loan borrowers was over 90 days late on payments. That's the highest delinquency rate on student loans we've ever seen. Now, we know that's partly because student loans were deferred for a while, but it's still not good, right? Millions of people basically are sliding into default. Credit scores are taking hits. Since the repayment of student loans started back up, over 2 million people saw their credit score drop by more than 100 points. Another 1 million people got slammed with a 150-point drop or worse, right? These types of hits can take you from average to horrible overnight. And they need to be discussed and talked about. In other words, more Americans are drowning in debt and falling behind and paying the price with messed up low credit scores. Listen, here's a few reasons bad credit is destroying people left and right. And if you've experienced any of these or you know anybody, let me know in the comments below. You got job applications. Think about this. Many employers out there, they run credit checks on the history of you being able to pay back, and poor credit can cost you a job opportunity. In many instances, even though there's no real proven correlation between your performance on a job and your credit score, some jobs don't care about a correlation. They just look at you as having bad credit. They don't want you around. Then you got insurance premiums. We all know what's happened to the cost of insurance over the last couple of years, right? Homeowners insurance, auto insurance, they usually charge a little more for people with low credit. I read that in some states, homeowners with bad credit pay nearly $2,000 more for their insurance. I mean, just let that sink in for a moment. You got to pay more insurance. You may not get some jobs. That's tough. Not to mention, think about trying to get a place to live, right? Many landlords still run credit checks, and bad credit can lead to higher deposits or an outright straight up rejection. And you can't rent because you have poor credit. And then you think about even smaller things like deposits for utilities, right? There's some utility providers that require deposits and sometimes deny you outright because of you having poor credit. What I'm trying to show you is that there's many ways that this bad credit thing can silently hurt you that you just may not even be thinking about. So when you have bad credit, you're paying higher interest rates on loans, whether for cars, for mortgages, and you have to spend more money out of your pocket on that stuff as opposed to spending more money out of your pocket to invest. And when I say bad credit, let me just be specific. Bad credit is generally defined by credit score range. We have something called Fair Isaac Corporation in America, and for short it goes by FICO. FICO calculates these credit scores. It uses the data from each of the 3 reporting agencies to generate a score. You technically have 3 different FICO scores, one from each credit reporting agency, right? You have a FICO score from Equifax, you have a FICO score from Experian, and you have a FICO score from TransUnion. Now, most lenders, they use the FICO score from one of those reporting agencies. So credit cards and auto loans, they typically pull from one bureau. Now, mortgages almost always pull from all 3. When you go to get a mortgage, they're going to pull all 3 and then use the median or middle score, not necessarily the average. These FICO scores can run anywhere from 300 to 850, right? So here's how the ranges usually break down: bad or poor credit, fair credit, good credit, and excellent credit. In general, if your credit score is below 640, it's typically considered bad credit. And let me mention this because many of you have not even heard of this yet. But starting soon, I don't know if you've been watching the news yet. Let me know in the comments if you've heard of this. Big changes are coming to credit scores. FICO is going to begin factoring in what they call buy now, pay later loans into their new models. So those 4 easy payments, right, can now help or hurt you just like a credit card. At the same time, VantageScore 4.0 is now approved for mortgages. So what this is doing is it's opening the door for millions of people to potentially qualify if you have a good buy now, pay later history. And in terms of medical debt, there was an attempt last year to wipe off medical debt off of credit reports that basically got struck down. So for now, those bills do still count. So the point is, new things are coming in terms of how the FICO score is actually measured. Just be aware of that. Listen, if your credit is holding you back, whether it's low credit or no credit, you're paying the bad credit tax every single day. Higher interest rates, tougher approvals, and fewer opportunities. That's why I want to put you onto something that can help you safely and easily build your credit. It's called Kickoff. Now, Kickoff is the #1 credit building app in the App Store, and it's designed to help you strengthen key credit factors like your payment history and like utilization. With plans starting at just $5 a month, there's no credit check, no interest, and no hidden fees. You sign up in minutes, turn on the auto pay, and your on-time payments get reported to all 3 credit bureaus. That's huge. With Kickoff, small steps can make big changes. Users with credit under 600 that made on-time payments have increased their credit by an average of 25 points in their first month and up to 84 points after their first year. And here's the kicker with Kickoff. Kickoff is only for building credit. It's not for spending on purchases. That means you're creating a positive payment history without racking up any more debt. And that's big. Better credit can mean saving you thousands in interest over time. And that's money you get to keep in your pocket. Right now, Kickoff is giving my audience 80% off your first month. That means getting started for as little as $1 when you use my link in the description box below. Do yourself a favor, click on that link and start working on your credit today. Now, let's get back to the video. The big deal about bad credit is it limits your ability to buy appreciating assets, which in my opinion is the primary reason you want to have good credit, so you can stack appreciating assets. And the other thing that's important to mention is that many people try to repair their credit, right? But they fail to stop the mistakes and behavior that led to the bad credit in the first place, right? So for a lot of people, the cycle repeats. Sometimes you'll see people even go get bankruptcy, right? But next thing you know, after bankruptcy, they're still in the same place. And part of that is because you got to change behavior if you plan to change your credit. Now, let's talk about how to fix this thing, because I don't want to just have an all doom and gloom video. I want to give you some practical things you can do to fix your credit. First, use a tool like Kickoff to build positive payment history safely. Again, check out their link in the description box below. But also, you want to start to make sure you're intentional about paying your bills on time and prioritizing the bills that are attached to payments on things that report to your credit history. Don't push your credit card payments off, right? Don't push your mortgage payments off, right? If you can help it. And then, watch this, you want to lower your credit utilization, and you want to aim for credit utilization under 30%. Now, what does that mean? Here's an example. If you have a credit card that has a $1,000 limit on it, don't let the balance show above 300. Better yet, don't let the balance show above 100. But 300 is 30% utilization of a $1,000 credit limit, right? And another way you can lower your credit utilization is to ask for credit limit increases. Call or request it online if you have to. A higher limit instantly lowers your utilization rates as long as the balances stay the same. For example, a $1,000 balance on a $5,000 card limit is a 20% utilization rate. The same balance of $1,000 on a $10,000 limit is only a 10% utilization rate. You decrease your utilization rate just by increasing the limit, which you can do by simply calling them or requesting it online. Or another thing you can do is pay the bill twice a month. Don't wait for the due date for a bill. Pay mid-cycle and before the statement closes to keep reported balances low. Just make sure that you also avoid maxing out your cards, right? Listen, even if your total utilization on all your open credit lines is fine, if you have one card that you have a 90% utilization rate on, it hurts your overall score. So distribute your usage among your different credit lines that you have open. Listen, these are just ways to lower your utilization rate and ultimately bump up your credit score. Another thing you can do to watch or fix your credit is simply to audit your own behavior, like I mentioned. Identify where you overspending money. Identify some of these subscriptions you stopped using 2 years ago, but you forgot about, and they're coming out of your paycheck every month, or out of your bank account every month. And watch your impulsive spending. Limit your use of buy now, pay later. Never be out there at the payday loan place down the street in the strip mall. Just don't do it. And close any unnecessary accounts. Now watch this. You're going to say, why are you telling me to close accounts? Yes, temporarily, when you close an account, it's going to hurt your credit by increasing your credit score, right? But it also helps to limit temptation because, again, a lot of people have a behavior issue that hurts their credit. So when you're trying to get your credit right for the long term, closing a few things that ultimately could tempt you into using them is okay, because you're not going to be borrowing money for a while. You're not going to be borrowing big chunks of money while you're trying to work on your credit, right? And your credit score has time, ultimately a few years down the road, to recuperate from the hit it's going to take when you actually close an account. So people say don't close an account because it raises your credit utilization, because when you close a credit card, for example, you lose that card's credit limit, right? And when you have less credit limit available, your balances make up a bigger percentage of your overall limit. So when you close a card, your overall credit utilization is going to rise a little bit, and that's going to hurt your credit score, right? And again, we want you to stay under 30% utilization. So when you close a card, it's going to have that negative effect on your credit. And also when you close a card, it can shorten your credit history. And the length of credit history makes up about 15% of your FICO score. So let me say this. I'm not against using credit when it's on things that are appreciating or going up in value, like a home or some other type of investment. Or when you have self-control, credit cards can work for you, not against you, right? Look, good credit can give you access to lower mortgage rates, access to lower rates in general in terms of loans. It can give you cheaper insurance, better job prospects and opportunity, better rental prospects and opportunity if you're looking to rent a piece of property or something. And not to mention, it can give you peace of mind and some financial flexibility in terms of what you can do and what you can't do. I'm all for those things. Look, you may say to yourself, look, America's in debt, so why should I fix my credit? If America owes $37 trillion in debt right now, what I look like out here fixing my credit? I've heard this a million times. Listen, I don't know. I don't know how you live your life. You have to figure out what you believe in and look yourself in the mirror every day. If you plan to live your life like Congress in America runs the country, good luck on that. That may be a miserable life, to be honest with you. But the bottom line is this: bad credit isn't just a number. It's like a chain that holds you back from jobs, from housing, from lower cost insurance, from the ability to invest in appreciating assets. But it's not a life sentence. Just because you got bad credit now don't mean you always got to have it. With some behavior change and using some smart tools like Kickoff and a strategic approach, you can flip the script on this whole credit thing. You can build good credit and turn that credit into a stepping stone instead of a roadblock. Listen, if you got value from this video, let me know in the comments section. I got value. Smash that like button, and most of all, this is the most important piece, share this video with your network of people and across your social media platforms, because there's a lot of people out here that need to hear this message about credit. Speaking of which, if you're a new investor or if you're just an investor who's looking for some low risk investment opportunities, do yourself a favor, check out this video right here where I give you the 10 best low risk investments, better than a savings account. Peace.